All right. Well, welcome everybody to the April 2020 edition of the Roundtable. We're going to talk about Vertigo markets tonight. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors of this event. And I'm joined by three stunningly handsome, good dancers who know how to pick stocks. My friend Ken Kavula from the Mid-Michigan chapter, nationally renowned educator. Good evening, Ken.
Good evening, Mark. Good evening, guys.
And from the southern end of I-75, Cy Lynch from Atlanta, Georgia, is joining us tonight. How you doing, Cy?
I'm doing well. How's everybody else?
We're doing good. And for the one night who's not attached to I-75, Hugh McManus is coming to us from, I believe, near Pasadena, California today. How's the weather out there, Hugh? He may have muted himself. But that setup question from the audience in the green room before the session is perfect because Hugh is quite taken with the damage done to the airlines, and he will be presenting United Continental tonight. So while he sorts out his microphone, we'll just go ahead and get underway. Is that you, Hugh?
Yeah, I'm here. I just realized that I'm
Okay.
I'm on the phone as well because the phone's working, but sometimes the internet connection doesn't.
All right. Well, greetings and welcome. Good to you're actually getting a little less travel in these days, huh?
I was actually just looking at that a few days ago. This is the longest continuous period I've spent at home since August of 1992.
Oh, man. Wow. A 30-year low.
By a reasonably wide margin.
30-year high. Wow.
Yeah.
All right. Well, we're gonna talk about a crazy market that's been crazy is a good word for it over the last several months, and I'm bringing a little bit of personal story to this one. I actually had a vertigo eruption on, I don't remember what day it was, Thursday of last week, and I did one of those things that I never wanted to have on my bucket list. I actually took an ambulance ride to the hospital. It was pretty intense with sweating and dizziness, and we had to rule out anything cardiac. I am pleased, very pleased, so is my wife, pleased to report that the cardiac stuff went extremely well. The doctor accused me of being 40 from that perspective. He did tell me I could lose a couple pounds, but everything checked out pretty well. But I know there has to be statistically several people in the audience that know exactly what I'm talking about when it comes to vertigo. It's no fun at all. And it was the first time I had experienced it. And I think I'll tell you from watching this market over the last several months, it's a pretty good descriptor. So we're going to try to wrap our arms around that a little bit tonight. All right, let's go ahead and get underway. Here is the legalese stuff. No investment recommendation whatsoever is intended. We do this basically every final Tuesday of the month. We've been doing it for almost 10 years. You're going to see more about that in a few minutes. It's all about the education. It's about a demonstration. The things we do are to illustrate the methods and the principles of the modern investment club movement, whether it's interpreted by Manifest Investing or promulgated by the National Association of Investors or Better Investing. We basically are going to be dealing with real companies in real time, showing you how we subject them to the analysis techniques and methods. And again, do your own homework. We will try to tell you if any one of us has a stake in a particular company, but again, do your own homework. If you'd like to have an event email reminder and you're not already on the list, or if you have a family member or a friend who you think should be on the list for these type of events, send an email to nkabula1@comcast.net, and Natalie will be happy to keep you abreast of any future meetings. If you have follow-up Q&A, as Ken was saying, we do stick around and answer questions and try to answer them all, but if you have follow-up questions or you would want to copy the slides, send an email to markr@manifestinvesting.com. All right, here's our agenda for tonight. This has been the type of thing we've been doing monthly for almost 10 years. Again, welcome, especially if you're joining us for the first time. We do keep it fairly informal. We do field questions from the audience. And again, we do stick around and try to answer as many questions as we possibly can. Our discussion will be wrapped around, I'm actually quoting myself here, last month was a good year, but last week was an even better year. I don't know, I mean, the last month has fit that picture. And of course, everybody in the room knows that the opposite was true in March, end of February, and all through March. I think we had a bad decade in there during one of the weeks. Pretty tough stuff. We'll talk about our performance results. We will talk about some stocks that are on the hot seat tonight, known as our challenge method. You can see the 4 stock presentations there. There's an audience poll after we make that presentation, and we do try to stick around for some open Q&A. Just as a reminder, we've been doing it monthly. We are trying to share an actionable investment opportunity, and at the risk of repeating myself, actionable does not mean call your broker. It means study and form your own conclusions and judgments about the investable nature and the suitability of any of the companies under consideration. We do like non-core selections to be part of the portfolio. Some of them have bolstered it quite a bit. Our objective is to beat the Wilshire 5000 by 5 percentage points over the long term. We'll take a look at how well we've done, and we would like to see a majority of our selections actually outperform that benchmark index. Thought we might spend a moment putting a finer point on this Vertigo market thing. What you're looking at here is a almost 20-year chart. Those are blue quarterly bars of the average or median price forecast at Manifest Investing. You can see that number ranges from 0 to just short of 20%. You can see those spikes during the Great Recession of a little over 10 years ago on the left side of the graph. But what we want to pay some attention to, and in fact, we have done presentations on these chasms in the price. Again, that's the Wilshire 5000 that is in the green area. And those big white areas, we call them chasms. And there's some fairly notable peaks there also. And we noted that even just a month ago, the market has been spinning for the last several months. And sometimes all we can do is put our head in our hands. I don't know about you. I actually don't feel good when I wake up in a half hour after the stock market's open. Some of my stocks are up 8% because that just doesn't feel real. It feels actually kind of nauseating, and that's part of Vertigo too. And Cy, we were talking a little bit before the session. This is kind of what you were talking about. About a month ago, we noticed that many of the stocks and in the tracking portfolio, basically the average for the tracking portfolio was approaching the market median return forecast. We call it MyPAR, where they were basically kind of bumping up against each other. And we asked the audience for permission to just kind of, chill for a bit, thinking that if prices go up and the fundamental analysis behind all the stocks that we follow basically get trimmed or moderated a little bit, that'll begin to correct yourself. You're going to see that that's actually happened. So, Cy, that's something you were concerned about. Is that kind of what you were getting at earlier when you were talking about it?
Yes, that is, and you can see in this chart that it's certainly starting to diverge again, and I just wonder if there's still not some more of that to happen. But yes, that is exactly what I was talking about.
Yeah, some of that will be cleaning up over the next couple of weeks as the analysts complete their next round of updates. So we'll go for that. Also wanted to check in on our recession watch. I think the recession is probably, at least if there's a toe in the water here. I have to tip my hat to Hugh. He actually sent me a picture of a sweatshirt with that coffee cup label on it. And for those of you that can't read it, it says EBITDA with a C on the end of it. So I guess that's EBITDAC, unless there's an Irish pronunciation that I don't know of, Hugh. But it's earnings before interest, taxes, depreciation, and amortization, and coronavirus. So the top graph is actually the EBITDAC graph. You're looking at the median profitability of the value line industrials towards the end of last year. And as you step down to the bottom, that's actually updated as of the close of business tonight. The numbers that used to be up in the, again, 8, 9, and 10% range, again, just a few short months ago, are now down in the 6. You can see just 8, and very little, nobody's up around 10 anymore. and the overall trend has been toggled down from 9% at the long term down to something closer to 8%. That's not an insignificant change. That means that the average stock in the universe of stocks has been trimmed, and we're talking the long-term profitability by about 10%. And one of the things that we have made a point of pointing out is, again, 10 years ago, this was one of the nastiest times in stock market history, right? Back during the recession that accompanied all the ugliness of the financial distress that happened back then. Well, this is what profitability looked like back then. And we're basically approaching that now. And I have a theory that as we get closer to 6%, we could actually be looking at kind of a tipping point for the economy. I hope we don't get there. I hope we get to the point where the triage begins to kick in and the profitability expectations for this year can stabilize a little bit. Any comment on that from any of you?
Yeah, Mark, I have a question, Mark. Aren't we about finished now with the 2020 earnings? Hasn't that bar basically stabilized now? Isn't that, there's very few companies that have yet to report their 2020
You're thinking 2019.
earnings.
Yeah, 2019.
Oh, goodness. Yeah. Okay. Thanks, guys.
Yeah, and
Never mind.
and that was the comment I was going to make. We observed it last month, and I think your observation is a good one, Ken, in that now just about all the 2019 earnings are in, although VMware is not yet in Value Line. It is in, but Value Line's cycle hasn't picked it up yet, so there may still be a few. But no, that's the line that I almost am looking at even more than the 2020 and 2021, which certainly are important, but they are COVID related to a great extent. Again, anticipatory, but notice that difference between the two charts in 2019 earnings. They're down by about 1.5 percentage points. And notice it was anticipated to be above 2018, and now it is coming in below. So again, that's a pre-COVID number. So that's something saying that there was some weakness in the system before the COVID shock, and then you're throwing the COVID shock on top of it.
Yeah, I would concur. I think you're absolutely right. I would point out that the issue 13 for Value Line is actually next week, so the next weekend update, and then some of the more extended coverage companies will be tidying up their stuff. So yeah, the 2019 number will be locked in. Many of the companies in the oil and gas and some of those recreational fields came in this week, and they put a dent in some of these numbers too.
I was going to make 2 points on the graph, so I think the graph still makes it, even though I was 1 year off. Mark, could we almost call the 2020 numbers a little bit untethered to any kind of reality? I mean, we're looking at analysts that no longer are being guided by a lot of the companies. We're looking at them trying to decide what's going to happen when they've never experienced a cessation in the economy, such as this one before. And I'm just not sure that any of those 2020 numbers right now, at least, are tethered to anything except guesses.
Well, I have a feeling they'll tighten them up between the week between Christmas Day and New Year's Eve. That was a joke.
Well, I'll buy it though.
Yeah, because then we'll know what actually happened, pretty much.
Yeah.
No, I would agree, and I would use Disney as an example. There was a survey put out on the internet as to when people believe that the Disney theme parks will return to full capacity. And a bunch of analysts were responding to this, and the spectrum of responses was staggering. Anywhere from end of June this year to end of June 3 years from now. And, depending on what actually comes to fruition, the way those numbers would affect Disney are basically staggering, right? So
Yeah.
a whole lot of
Yeah.
uncertainty.
And one thing I'll mention, and let's see, this is the end of April. So you're talking to really, we're probably 3 months out before. Well, first of all, let me say I agree with Ken and you, Mark. I don't see that there's much reality that you can tether 2022 right now. Although, and we're probably at least 3 months out from something. But remember, even though we have had a complete shutdown, and of course, Disney, a huge piece of their business, we know is shut down and is going to stay shut down for some period of time. Who knows how long? But realize that there are a fair number of companies that are adapting their business models and to shifting more online, restaurants shifting to takeout and so forth, all of which may or may not have significant impacts. But I don't, I think once we see second quarter figures, it will be interesting to see how many companies maybe have adapted better than we expected or worse than expected.
Mhm.
I have no way of knowing for publicly traded companies because, again, I think it's going to be second quarter figures that will show it. But I do know some private business owners, particularly of small restaurants, that are doing amazingly well.
True. Well, I actually have the magic key to all of this if you guys are interested.
Please share.
I think the entire recovery can be pegged to when Hugh McManus buys his next airline ticket.
Yeah.
Let's press on after that moment. All right. Here's how we've done. Some of the people who are joining us for the first time think, who are these babbling guys? Hey, we keep track of the stuff that we do using a tracking portfolio. Here's what it looks like over the last several years. The graph that you're looking at is a measure of performance. Anything above 0 would mean that the tracking portfolio is beating the market. Our objective is to beat the market over the long term by 5 percentage points. That's the red dotted line. And we're doing that. We speak in terms of relative return, always comparing our investments versus what they would have done if they had been invested in a vanilla stock market index at the same time. So the rate of return since inception, again, that was July 2010, is 15.9 today. The Wilshire 5000, again, using mirroring investments to calculate a rate of return, has generated about an 8.8% rate of return. So the relative return is just 15.9 minus 8.8, 7.1%. And again, approximately half of our picks beat the market benchmarks. And I think it's time for a cyber thank you or prayer of Thanksgiving or whatever you want to do out there. This has been fun, and let's hope that we can continue as we approach that 10-year threshold. Any comments or questions, Ken?
No, it's the picture is a lot better than I ever anticipated it being when we began this exercise, Mark. I really did think that with 4 guys just kind of choosing stocks that they thought were good additions, that we'd be lucky to hit that red dotted line, and we're doing okay for a bunch of folks that don't spend our lives immersed in the stock market.
No, it certainly is a testimonial to the investment club mystique, that's for sure. All right, here's a little context. This is a little foreshadowing for July. We're going to have a lot of fun in July, assuming that I haven't jinxed us here tonight. That rate of return over a 10-year period, this is some of my favorite and some of the top performing mutual funds on the planet. We would be in second place. And I will be putting together a list of those who might have beat us, but it won't be a long list. And again, God willing, and if the performance continues to be strong. So we'll keep after that. It's one of the things we'll be watching.
Yeah, Mark, could you stay on that for just one moment? Because we
Sure.
seem to have a number of people that are just a little bit confused. We have a larger audience than normal tonight, which means we probably have some folks that don't come on a regular basis. Relative return, folks, is nothing more than the annualized number minus what a benchmark would have done for the same investment over the same amount of time. So if you can go to that slide with the face, there it is. For the first line, it's just 20.2 minus 10.4, and that's where you get the 9.8. And for investment clubs, ever since they began in the 40s, we've suggested, the gurus have suggested, that if you can beat the market by around 5 points, you're doing extremely well. So a lot of these mutual funds are doing okay, and the top four are doing more than okay. And our relative return is at 7 something, which puts us in second place on this list. That's why we're kind of celebrating what's going on right now.
I crossed out that top one because I made a mistake on the spreadsheet. That should be 12.2 also.
Okay.
So
Right.
that means we're even closer. Maybe we can take over the pole position by then. All right, and for those of you that have been around us for a long time, Ken and I do our Halloween thing, and we talk about Brown Small Cap Company as a source of ideas. We're going to be talking more about Delaware, I'm sure. New Horizons as a source of ideas. Vertis, KAR. There's a reason that we watch the stocks that those guys pick. All right, let's move to a snapshot of an excerpt of the total portfolio, the tracking portfolio. These are the top 20 positions by value or percent of total assets. The legend up at the top provides a key to the number of times these individual positions have been selected. So in the case of Microsoft, the investments we've made, we make a $1,000 investment into it every time it is chosen by one of the knights or damsels or the audience. So $1,000 into them, and you can see that Microsoft, I think, is up here under the 5-time entry. So $5,000 has been invested in Microsoft. It is now worth almost $38,000. So you can break down the chart from top to bottom. There's some household names on here. There are some that are not quite household names. Any comments, guys?
I just want to remark, as we go later, Mark, I just want to remark that Global Payments and Dollar General are both on this chart as we move to the next slide. I know what's coming up, so I want folks to keep those two names in mind.
Yep, they've made us happy. Global, in fact, I'll be talking about it in a minute. Global Payments is a one-time selection. So $1,000 is now worth $8,545. All right, so let's go ahead and talk about the next one. These are the challenge stocks. All this is taking the overall dashboard and sorting from the lowest projected annual return, the lowest return forecast, and basically picking off the ones that are the lowest. And I basically am tossing that out there as a blanket sell recommendation for the group because I want to honor size continuous nudges over the last couple of years that we have to keep the design of the portfolio, in other words, the portfolio projected return, suitably above the market. And Ken, would you like to go ahead and explain how the mechanics of how this works? And this is worth a few extra moments, guys.
Sure. Manifest tracks a lot of data for us automatically as we put it onto a dashboard. And the two numbers that track in a regular way are MyPar, and Mark's talked about MyPar a couple of times already this evening. MyPar is nothing more than an average return for the average stock in the entire database. So about half the database will do better than 11.3% potentially, and about half the database will do worse than 11.3%. This number changes with price change on a daily basis, or at least every day that it trades. Par, on the other hand, is the weighted return from the portfolio. And again, it's an anticipated number. It's nothing that's actually happened, but it's the potential going forward. We'd like to keep par about 5 to 10 points above MyPar. So we'd love for the par in the portfolio to be somewhere around 16 to maybe 21 or 21.5%. Mark's underlined the exact arithmetic there. We call that the sweet spot. And right now our par is really pretty low. It's just 0.7 above average. So to raise the par in the portfolio, you can do a number of different things. But one of the first things you might consider doing is selling stocks with, at this point, a below average par number themselves. So the list Mark has are the, I don't know, maybe there's 10 stocks on this list, and they're the lowest pars in the entire tracking portfolio. If we were to sell them, they represent, by the way, about 10% of the whole portfolio. If we were to sell them, that would automatically move par up. And that's one of the goals that we'd like to achieve as we continue to manage this extremely large portfolio.
All right, and the thing that I mentioned, global payments, that's one that we're basically ready to start naming grandchildren after. It's been that good to us. Cy, do you have any comment about its participation in this thought process? In other words, should we wait on that or not?
I was starting to talk and I had myself muted. I didn't know this was coming, so I did not check against my own, because I have owned Global Payments and I follow it in my growth stock outlooks column. I do know that historically Value Line, which certainly strongly influences Manifest, although it's far from exclusive, and that's why I don't know, for whatever reason has traditionally underestimated Global Payments. That said, even if there is some disconnect, if you want to say it, between the consensus judgments and what I would find to be somewhat more realistic, I think Global Payments has had a run, and I doubt that it's going to close the gap toward my par as much. And so a long way of saying it's more on my gut than my 100% knowledge, but I wouldn't, a part of me wouldn't say let's let Global go a month and just see, but on the other hand, it has certainly had a run.
All right, well, let me, I'll amend my, can I amend my motion? Sure I can, because this is Robertson's Rules of Disorder. We can do whatever we want. My suggestion would be, how about if we follow up after this meeting with an audit of Global Payments? And if it's dramatically different, we keep it in. We basically make the sale subject to the audit, confirming that it's somewhere in this neighborhood of a fairly modest return compared to what we need. So
that sounds fine to me, and certainly I'm not looking at, I mean, if the audit increases the return to 8% or something, I don't know that would be enough to change my opinion, or
right.
to sway, to make me say hold it as opposed to sell it.
Okay.
Now, if it doubles it, that's a different issue. But.
All right, so let's see what it looks like. And Hugh, what about Gilead? I mean, it's a non-core position for sure, and it's got so much momentum. What's your thinking from 35,000 feet on Gilead?
Well, long term, I think the company will do really well. I bought it right before the extent of this whole COVID thing really kicked in. I think it was added in January, right?
That's correct.
Yeah. And, it has remdesivir, which is an antiviral that may or may not prove to be effective against COVID-19, the disease. Who knows? But, realistically, even if it does work well, it's not going to add an awful lot to the company. I think this is a situation where even if I love Gilead so much, I still have to think about the portfolio. So this is groupthink. You don't think of yourself when you're doing social distancing, you're thinking of others. And maybe it's time to social distance Gilead for the sake of the
I like
portfolio.
it. I like it. We're socially distancing from these low return stocks, huh?
Mark,
Yeah.
I'm gonna focus attention on one other column on the chart here too, and that's that growth column. That column, folks, is sales growth, and we were taught by the folks that put together the Better Investing movement that if you were going to beat the market by that 5 points or so, then your sales growth probably needed to be up in the 11.5, 12% range. And all of these stocks, with one exception, have really, in my mind, some of the slower growth in the portfolio, which just hammers home the fact that maybe we need to move them out and move on with what we have left then.
Okay, yeah, we'll definitely be. We're looking at before and after and making that type of judgment. All right, so that's what we'll go ahead and do. We'll do an audit on global and decide from there. All right, thanks everybody. And we didn't come in too bad on the timing. It's about 9 o'clock, so let's go ahead and go with the stock presentations. And Ken is going to present Hexel. I'm sure we've not heard anything on this company, so take it away, Ken.
Okay, this is a company that we don't have in the portfolio right now. And when I start researching a company, especially for the roundtable, but for my own portfolios as well, I usually start with one of these chronicles. Every single stock in Manifest has a chronicle, and you can see that it's 4.5 years of data. The blue line is the quality number for the stock. And the first thing I'm looking for is a quality number that has stayed constant somewhere above 80, or perhaps a quality that's been generally on the rise over the length of the graph. I think that's what I'm looking at here for the most part. Most of the moves in the quality have been in an upward direction, a little bit of wiggling around once it got above 80 there, but I like the quality, so that passes my first test. The second thing I like to have happen when I'm buying a stock is I love to buy a stock where the return is somewhere at the high place in the last 4.5 years. That's the red graph. And if you look at the end, that last data point right there is at the end of March. And that is showing me a return of about 18%. Well, the piece that I captured on the bottom is showing me a return in today's market. That's actually 1 day old. So that red line's actually gone up 4 more points in the month of April. We will have a data point on the graph on the last day of April, but I certainly am buying the stock. If I were to buy it tonight, I'm buying it at a 4.5 year high return, and that's when I like to do the buying for the stock. So it meets the requirements that I set for the Chronicle. Next slide, Mark. So the next thing I do is I begin to look a little bit about what the company does, and I try to set a thesis. This company works in commercial aerospace, space and defense, and in the industrial segment. You can see the types of things that its components go into, wings and fuselage systems and engines for the commercial aerospace division, and that's both for Boeing and for Airbus. In the space and defense, it does a lot of work with fixed wings, they call it new design, but basically what it is shapes that you don't normally see pressed out of aluminum or steel. And they do an awful lot of work with helicopters. And then in the industrial segment, a lot of their materials go into wind turbines, a little bit into the marine markets, a little bit into the automotive market. $2.3 billion in sales, so not an extremely large company, but a good, decent, medium-sized to small company. Next slide, please. The composites that this company makes, and they work on all different kinds of composite materials. are now making up about half of what goes into a plane. My thesis is that we're not going to stop flying. I think it's the same thesis that Hugh is going to use when he presents his talk later on tonight. And if we're not going to stop flying, then there's going to be a need for planes. We know right now that manufacturing in planes has come to a standstill. This company, Hexcel, is one of the leading suppliers of composite materials to the aviation industries. And I think that that is going to be an industry that opens up sooner rather than later. I think that at some point the large plane that's grounded right now from Boeing is going to fly again, and they're going to have to resume manufacture of those planes. They have a lot of orders. Even though they might have some order cancellations, I think from being shut down, they'll have a little bit more of a backlog to deal with. And I think that the composite is going to be something that is going to be needed by all of the markets that Hexcel speaks to going forward. Next slide, Mark. They have an unrivaled product range, and you can read for yourself. One of the biggest products is carbon fiber, and I've learned quite a bit about carbon fiber in the last 2 days. So next slide, Mark. I kind of brought it down to this one slide from their investor presentation. Did you know that carbon fiber is 5 times stronger than aluminum, 30% lighter than aluminum, tougher, stiffer, and more durable than aluminum? And by the way, it's stronger than steel. If you didn't know that, you do now. And that's why it's being used. The lighter part of it especially, the tougher part of it especially, makes it very suitable for use on things that fly way up in the sky and need a lot of fuel to keep them up in the sky. Next slide. The company has a little bit more debt than I would prefer, so I looked into their debt. I was pleased that they have laddered a lot of their borrowing out to 2027. That helps deal with paying back. And their interest coverage, which is a number not on this slide, for the last 10 years has consistently stayed at around 9 or more. A good interest coverage is usually 8 or higher, so the interest coverage of 9 or better for a long period of time gives me confidence that this company will be able to weather the storm that right now is hitting their business. Next slide, Mark. There's the lines. You can see the business dropping off in the first quarter. They lost some business almost immediately as Boeing shut down, and then the suppliers began to shut down. I've decided that I'm going to do my projections from the end of the trend line rather than from the last quarterly piece of data. And I'm going to keep my projections going from the end of the trend line until I feel that we're past the effects of the cessation that occurred in mid-March in the entire economy. Next slide. I'm looking at growth rates of about 6% for the next 5 years in sales and about 9% in earnings. Profit margins have been very steady over a long period of time. Return on equity numbers are good to excellent to superb. And while the debt's a little bit high, I think I already addressed the debt coverage at 9 or better for at least the last 10 years. When I'm using all these values, I'm getting a good solid buy for this company. I'm getting a total return of about 33%, a projected average return, a par value of about 29%, and that puts this in the same general ballpark as the manifest numbers, which gives me some confidence in the stock selection guide. So I'd like to put, I don't think I have any more slides. Do I, Mark? One more? Oh, I'm sorry. I did capture the last two paragraphs of the value line report. Notice the date, brand new report from May 1st. And they predict that in the next 3 to 5 years, the stock should be back where it started this year as far as price is concerned. That's another way of saying they expect the stock to be somewhere in the high 70s up to perhaps as much as $80. It's an attractive opportunity for new investors. They envision a wide long-term recuperation potential, and this company ended a potential merger with WAB. Let me get the right name of the company, WWD, Woodward Governor. And the possibility or the probability is that once we go back to any semblance of normal, that the two companies will begin those merger talks again. That's it for Hexcel.
Okay, thanks, Ken. That's kind of a staggering red, underlined in red, when you think about how rewarding that would be in the opposite direction of how bad the fall has been. Something else. All right, sticking with scooting around in the air, Hugh McManus is going to take us to United Continental. Take it away, Hugh.
Hey, how are you?
Good.
I'm using the phone. The audio connection isn't great here, so it's a bit delayed.
I can hear you pretty well.
Good. So I'll run over the selection process that I generally follow, and that is I like to buy companies that I already own. And if I own the company, or even if I don't own it, I like it to be near a 52-week low or a multi-year low. If it's a large company, we're talking about companies with tens of billions of dollars of revenue, I like it to be near a 52-week low. If it's a small company, like these biotechs that I often like, I actually prefer it to be, so small cap, let's say, I prefer it to be near a 5-year low if possible, and not with any fatal bad news around it. Delay in the clinic is one thing, but running out of cash and cheating in clinical trials is a whole different thing. I wouldn't touch a company like that. And if it's in the middle, a mid-cap company, a 3-year low is something I'm looking for. A bit lazy. I like it to be low because I want the company to go up. And if the earnings engine is intact, then all else been equal, the future should at least mirror what's happened in the past to a greater or lesser extent. If I already own the company, that's great. If it's a new company, which is not this month, then it gets a lot of work. But in this case, I'm going to buy United Airlines again. I now own this company. Just to be clear, I bought it earlier this month. As Mark pointed out to me earlier this evening, it did dip after we talked about it last month, but it's back up $3 or $4 since I bought it. It was founded, 70, 80, almost 90 years ago at this point. It hasn't actually reported any recent financial information. It will soon. It has delayed, I think, its first quarter results, and the first quarter results won't be good. I flew with United in March on international flights on major routes from, let's say, London Heathrow to LAX, and in February and March, it was fairly light, and it was extremely light in the earlier part of March. Well, half of the business class was empty, which just is really unheard of on that route. So I expect the numbers not to be great, but also I would like just to give people a heads up that tomorrow, the estimate of the first quarter GDP will be published at 8:30 Eastern time, and that'll be another opportunity for people to set their hair on fire and run around the place. So I'm sure we'll see a lot of craziness in the market tomorrow. The results won't be that bad. I mean, I think there will be a very noticeable dip, particularly in transportation, but it'll be a portent for what's to come here in the second quarter. So again, I've just given some numbers. Last time I showed American and Delta as well, because those are two major international carriers, domestic carriers that you would compare against. But since I'm committed to United, I'm not going to do that comparison, and really nothing has changed either of those two carriers either. But it's a reasonably profitable carrier. It has a very large overseas international network, relative to its size, it's much larger than the other big two, Delta or American. And it carried 162 million passengers last year. And if we skip along to the next slide, we can just see that chart that I had before. It shows that it's the fourth largest carrier in the US in terms of domestic passenger count. Southwest is actually the dominant one at this point, followed by Delta, American, and a somewhat distant third is United. So if we move on to the next slide, certainly the SARS-CoV-2 virus has had a huge impact. United has canceled 95% of its schedule, or low 90% of its schedule. Aircraft are parked all over the place. Actually, not far from here, where I live, is an airport called Southern California Logistics Airport, or Victorville, as it's commonly known. That airport now has about 450 commercial aircraft sitting on its, well, they call it the tarmac, but it's concrete, sitting on the ground and blocking off one of the runways. There are more aircraft parked on that field than the entire fleet of Lufthansa and British Airways combined. It's an enormous number. And there are some videos on the YouTube where you can actually look at flyovers of that airport and see just a huge number of aircraft just parked and sitting and waiting. Good news for the airline industry is that government funding has kicked in, so they will be able to pay employees, and they will be able to do so, I think, until the middle of the summer. So in that regard, yes, it's bad that their assets are depreciating sitting on the ground, but still, some of their costs at least are being looked after by the government. So we skip on to the next slide, and this is a kind of a short presentation because, oh yeah, I've been stalking almost my favorite United aircraft that I like to fly on. United, this is a Boeing 757-200 N596UA. I actually got evacuated from this airplane 3 years ago. It was the best flight I ever had. Got to use that chute. There was an engine fire trucks. It was all very exciting. So I always watch this plane to see where it is. And the poor little baby has been sitting on the ground at SFO for the past month. You can go on FlightAware and look at any of your favorite aircraft if you're in or attentive about these things like I am. Most of us who travel a lot have spreadsheets, and we probably need help. And then if we move on to the next slide, I was just talking about the fact that I could have bought Love this week. Southwest Airlines is at a 52-week low today, I think. But my basic thesis would be to buy what I know. And years ago, I used to own a lot of Southwest, but sold it off a while back and haven't really looked at it since. Right now, I'm focused in on United Airlines. And I'm taking an approach very similar to what I did when I bought Bank of America 10+ years ago. The basic attitude is, you know, it's not that you shouldn't do a detailed financial analysis, but to some extent, it's not really necessary right now if you're committed or if you believe that things will improve. You may not know the kinetics, you may not know how fast things will get back to normal, but if you think the economy will get back to normal, then presumably all of the stronger components of that economy, including the big three carriers, should get back to somewhat close to where they were before. And as I said with the bank, basic thesis was things will improve or they won't. If they improve, banks will prosper because you need the banks for the economy to survive. And if the economy doesn't get back to where it should be, it really doesn't matter what you buy, everyone's in trouble. And I'm taking the exact same approach with airlines. Someone asked the question about the long-term prospects for airlines. I think they're good. We're a social animal. We primates. We like to meet with one another. We will get back to fly, despite all of this talk about Zoom, WebEx, what we're using here. We do like to shake hands. The British Airways had a great slogan 30 years ago that you can't shake hands with a fax. And the truth is that more business gets done face-to-face than it does, or more new business at least gets done face-to-face than it does online. This is what's happened to United Airlines since COVID hit of the SARS-CoV-2 virus. You can see that the stock has plummeted from 80 to 90. All the way down to 20 at one point. It got as low as 21 earlier this month. I didn't get that price, but close enough. It bounced back to 30, and now it's hovering near 26, I think, today. The volume has increased dramatically, and this is a 5-year look. And the reason that volume has increased has got to do with the fact that the stock market is really a very heated discussion about what the actual price would be. And since no one can tell the future, anyone with a two-bit opinion gets to vote. And most of those votes will be wrong, by the way, mine included, probably. But I work from the basic thesis that things will get back to close to what they were before. It will not recover at the rate that the panic set in. That never happened. But it will be slower, steadier, and more predictable when it happens. And that should be starting in about a month or two. And you can see it's more dramatic when you look at the 5-year history. And this is United Airlines and manifest investing. The purple line, or is it magenta, is the projected annual return. And right now it's looking pretty good, but that's because everything else is in the doldrums right now. But the quality of this airline is not so good. That blue line that's being highlighted right now. It's not a super high quality carrier. And maybe the next time there's a manifest investing instructional seminar, for those that are new to this webcast, maybe we can explain how this quality, the 4 things that go into assessing the quality of a company. It's a very interesting thing to learn about. But the projected annual return here is very good. My thesis is that the stock will triple in value. It might take 2 years, it might take a year, but I'm not sure how long it will take, but I know it will happen. At least I'm confident it will. So this body blow to the economy continues, and we're going to get at least some quantitative information tomorrow morning, 8:30 Eastern, 5:30 here in California, as the first quarter GDP results are published, the first estimate of what they are. I think you have to assume things will get back to normal. You wouldn't be on this webinar if you thought the economy wasn't going to right itself at some point. I don't think a detailed analysis of companies is all that necessary. I mean, it's good to do it anyway, but this is a question just of price right now, simply because the irrational animals are responsible for setting this price. In my opinion, they've set it way too low. And when things get back, so too will prices. And airlines aren't going to collapse. Government's not going to allow them to collapse. They're essential for the workings and long-term success of the economy. And when the economy recovers, as it will, the networks will bounce back. It might take a little bit longer for passengers to get back on planes and feel confident, but we saw that after 9/11, and there was a very good reason why you should be scared of flying back then. But after about 6 to 18 months, people got back on carriers and were flying happily again. So I think there's just one more slide, and it just basically summarizes what I said before. It's a virus. It's happened before. It will happen again, but we're now learning to cope with that. We had 100 years without a very serious pandemic. It was a very, well, yeah, HIV was a pandemic, but a very serious respiratory pandemic. There were, I guess, a few warning signs with some other viruses, but they were contained, so people didn't worry. It could have been a lot worse. It could get worse depending on how this virus mutates, but most of the time when they mutate into something that's not as virulent as it was before. I think the economy will get back to normal. Recovery does take a little bit longer than crash because, as I think everyone should appreciate, panic has a group on button. Once panic starts, boom, it just takes off like a wildfire, or wilder than a wildfire. But rational thinking takes time to come back. I don't know why that is. It's the way we've evolved as an animal, where a lot of other animals are. But it seems to have served us well in the past. Doesn't really serve us well right now, but what can you do? And the airlines will fly again.
All right.
Well, so I will add United.
All right. Thanks.
Don't sell it next month.
We'll double down. We give you some extra room on your leash.
Some runway.
Yeah, and just
okay.
and, one thing I just want to take a moment and encourage everybody. If many of us are familiar with 10 years ago, and he was saying, "I want to buy a bank," and half of the people in the room losing consciousness. And basically his premise was it might not get back to where it was from a profitability standpoint, but we're going to come out of this and they're going to return to a decent level. I think it's kind of history rhyming with itself here a little bit. So it'll be interesting to see how this one works out. All right, let's turn to technology and VMware. Thanks, Hugh. And Cy, go ahead and take us away.
All right. Well, Hugh and Ken have, I guess, taken us above the clouds, so we're going to fly right into the cloud. Public cloud, private cloud, hybrid cloud, they're all clouds. VMware, and we'll talk in a little bit more detail, but if you're not at all familiar with the company, essentially it deals with the cloud, both from a data perspective as well as a software and then an application and integration aspect of cloud. Here you can see the historical information. The last 3 years are rather wacky with tax reform aspects and so forth, but you can see a good steady sales line and pretty much an upward profitability line as well. Next slide. Like you, I frequently like to look at things that I already own, and that's really pretty much what I looked at this month, both personal ownership as well as the portfolio ownership. VMware I brought back in January. And you can see when I selected it yesterday, it was right at the bottom of the sweet spot in the portfolio. I also considered EPAM, but decided it relied on a little bit more price to earnings ratio, sustaining itself at a very high level than I really wanted. So I chose VMware. Next slide. Quickly did a stock screen. You can see the criteria down in the lower right, 17%, just rounding down VMware's anticipation, and a little bit rounded down the quality. And here's what you get. A decent set of companies, and I ranked them by financial strength, and you see that VMware is the highest potential return among those, or the highest growth among those first four financial strength companies. All of these companies are super excellent quality, and it's a good solid par as well, although you could get as high as Raytheon if I had wanted to go above the clouds, but decided to stick with the clouds with VMware. Next slide. Quick industry study ranked by quality. Again, good high quality companies all the way through those first six, and VMware is by far the best potential return among those. Before I go on, I will just mention the one at least potential psychological holdback for VMware for some people is that the company is 80% owned by Dell, which is a privately held primarily company. To me, there's a couple of ways of looking at it. Of course, if the company is very small, which VMware is not, then that certainly impacts the float and the liquidity. VMware is a very liquid company, so that's not a drawback. The main thing is, are you concerned with the fact that it is controlled by another company? Again, look at, frequently we say that a lot of insider ownership aligns management with shareholders. Here, you could say that's taking it to an extreme, as long as you trust the management that owns it, that being Dell, and the second issue being the liquidity, neither of which in my mind are disadvantages of VMware. But let's go ahead and get that out on the table at the very beginning. Next slide. Here's what it does. Again, I've been trying to keep it simple with cloud. And here's a little bit of the company's longer language. They're a global leader in cloud infrastructure, and they do have a business, I believe, in over 100 companies, 100 countries, and they're roughly 50-50 between the United States and international. A little over 50 international, a little under 50 in 2019 revenues in the United States. And then a little bit of their buzzwords: power to unlock new possibilities, and they seek to be a digital foundation for the IT side of a business. Next slide. Again, talk about digital businesses, and here's what they do. They're software, and they're principally a software provider spans computer, cloud, networking, and security. They've just made 2 acquisitions that I believe there's a slide that highlights them that hits one major one was on the security side, protecting data and applications. The other was on the application side. And again, they are a consultant and a software company that brings businesses into the cloud, which again, essentially, when you talk about private cloud, public cloud, hybrid cloud, you're really talking about the full range of taking a company's hardware servers, the actual machines that hold their data, turning that into a processing and data center that can be used across the company and can be scaled as needed by the company. That's a private cloud, to then where you had the data and the processing capability completely held in servers that are off-site and not owned by the individual or the company. That's public cloud, and then hybrid is some combination of the two. And that's, again, what VMware does, is they take a company's hardware as well as this publicly available hardware and brings it together on both a software or an application as well as a data storage aspect. Next slide. A picture of really what they're trying to do. They're trying to take all devices, all various applications, from the traditional, which is run on a desktop, to the run in the cloud to start with, to software as a subscription, which is kind of the model that most business has moved to if they're not writing it themselves. Most traditional business applications are internally written now. There aren't a whole lot of commercially available business applications that are not software as a subscription, which means annual or periodic subscriptions. And then, of course, cloud native, that's applications that were written for and reside in the cloud. And then the any cloud, that's just, again, a visual depiction of what I've been talking about when I describe private clouds and public clouds. And then you can see the servers and the data and the software. Those are the 3 symbols that those stand for. And then, of course, telecommunications are in there as well. Next slide. This is the slide that I mentioned as far as their acquisitions. You can see the pivotal. It's in green there in the bottom left-hand side. That's an application writer. That was a very large acquisition late last year. And then carbon black on the security side. And then you see the various other companies in between. Again, the VMware Cloud and Cloud Foundation, that was the core beginning of the company, and then they have expanded into these other areas, mostly through acquisition. Next slide. Again, what they're really seeking to do is they're seeking to take small businesses and medium-sized businesses and give them a full enterprise grade, that being a big business enterprise platform for any of their applications. That would mean, there's a lot of move for churches and nonprofits to have applications. That's would be an aspect of this moving into an enterprise grade platform, as well as all of the other things that you can imagine that you've just now started hearing about, as far as Zoom applications and the like. And then down there at the bottom line, you can see some of the businesses that they are partnering and involved with. Amazon Web Services, their own VMware clouds, Microsoft and Google clouds, as well as Edge. Next slide. 3 judgments in the bottom line. What is the projected growth of a company? I use 12%, just slightly above the manifest consensus, not significantly different there. I'm a bit below on the margin Margin figures for 2019 were a little out of whack, and certainly will come back down from that 63% that you see. That's again somewhat acquisition related. I was a little more conservative than the consensus, roughly in line on PEs. And so I come up with a projected average annual return of just under 17 versus the consensus of just over 17. Next slide. And then the chronicle that you've seen in the first two presentations. And again, except for the very extreme left-hand side of the graph, you can see that we're looking at just about the highest potential return that VMware has been at for the last 4.5 years. So it looks like a good time to buy. And it's not really something, it is betting on the recovery of business in that it is a business service provider. And if you are in a major recession / depression, then certainly service providers can take a hit just like anyone else. But on the other hand, it's largely immune to the virus, pun intended, as well as it's positioned to take advantage of even more digitalization that's probably coming. It was already well underway before the virus, and I suspect will continue even greater as businesses, and I'm not talking about whether you get on an airplane or have a Zoom meeting. That's, I think, on a much smaller potential scale than what I'm talking about. I'm talking about business moving their entire processing structures and data structures into cloud entities that are far more resistant to disaster of any sort than local clouds or local data centers. So
Excellent.
Let's buy some VMware.
Sounds good to me. All right, thanks. Yeah, I've seen VMware at work personally. Kurt used to work with it quite a bit. Cost effective, very reliable, good stuff.
Oh yes, and
Thanks.
they employed a whole lot of CTSH employees, Mark. So we're
that's an inside joke. All right. Well, probably the most important slide that you've seen so far tonight is on the screen right now. And it's what we've gone through for the first quarter of the year. Coffee consumption's pretty steady. Nobody's driving anymore. Internet usage is up. Shaving is way down. You watch some of these Zoom meetings that people have been having. I think the razor blade companies are in trouble. Alcohol consumption is theoretically increasing. Toilet paper, we had a bubble in toilet paper, and that seems to have recovered back down. The one I like to dwell on a little bit is sweatpants. I have not resorted to sweatpants yet, but it's tempting. But that's a pretty interesting trend in sweatpants. Where does it come to play? Last month, we talked about these companies as being possibly oversold, and I left-handedly joked about Gildan Activewear, GIL, towards the bottom, and Hanes Brands, HBI. Those are a couple of apparel companies that feature some underwear and sweatpants. Lo and behold, 1 month later, all these sexy returns that are on all these fancy companies, and here are these sweatpants companies. One of them's up 60% and the other one's up 40%. So there's money to be made in sweatpants, apparently. Current oversold opportunities. What I have done here is taken the manifest investing population, limited it to those in the top 40 percentile when it comes down to return and quality, and then demanded that they have a relatively low relative strength index. I'm not going to explain it, just going to say that when that gets down around 30, it means that a company is potentially interesting to do a study on. If you look back just 1 month ago, they were all in the 20s. A month later, after the stock market's gone up 12%, the lowest numbers are in the 30s. We lean towards the low end of that. The first company is Employers Holdings, ticker symbol EIG, decent return forecast, high quality rating in the top percentile, has a 13% projected return on owner's capital, trading near its 52-week low, on sale at a discount according to Morningstar, with a mammoth 1-year analyst consensus total return. The analyst consensus does not agree that it's as much on sale as others, but that's what makes markets. But you can see from top to bottom. Notice that Southwest Airlines made the list. Notice that Ken's selection of Hexcel also makes the list as being really beat up. This is a list of companies that have been really pummeled. And that's what we're shopping in, kind of the damaged goods, distressed merchandise end of the garage sale. Here's a look at employers' holdings for the last 10 years, I believe. 10 years. So we're basically at price levels first attained 7 or 8 years ago. So it has dropped from somewhere in the 50 range down to the 30 range, even dipping into the 27 range just within the last few days. All right. Well, here's what's causing that. They had an earnings report the night before last. They missed. They missed badly. And that shouldn't be a surprise. Everybody was basically expecting it. They missed a little bit worse than expected. I find it interesting that that image isn't exactly what they do, because this is a workers' compensation insurance company, and that's a property and casualty picture, if I'm not mistaken. And it just goes to what you see in the media. It's like he was saying a few minutes ago, look at the numbers yourself. We always encourage people to dig in and, watch for opinion, watch for skew, that sort of thing. Even that image alone is probably taking $1 off the stock price. So what do these guys do? Like I said, they are workers' compensation. They have been around for a long time. We're going to see that in an upcoming slide. The way that I would characterize them is they attempt to limit their exposure to what they call low hazard. They try to avoid lost time accidents where people are injured and are unable to work, and therefore that kicks in the insurance, and they basically are paid salary and medical expenses to be at home. They try to identify vocations where that's less likely to be the case, and they're pretty good at it. We'll take a look at specifically what does that mean. Been around a long time. Like I said, they are completely nationwide. They do have extremely strong balance sheet. They have an extremely strong balance sheet, very little debt. They have about 20 million in debt and almost 200 million in cash. And in addition to that, they have some investments. But quite a company. As I was saying, they target small businesses with less risk of avalanches of lost time accidents, from restaurants to some of the hospitality services, repair shops, medical offices. Again, the type of businesses where the incidence of that type of insurance being paid out is a little bit less likely. I just love the quote from the quarterly meeting yesterday. That's at the top. You can't make the point that you have a 100-year history much better than that one. Wouldn't you agree, Hugh? They were in place before and after the Spanish flu. So that basically, again, when Hugh comes at these things, with this giant thesis, I kind of look at it the same way. This is a company, they're not new kids on the block. They've been around the block a few times. They have some very strong, century-old relationships in place, and they've been pulling off the strategy very effectively over the last several years. So again, I looked at this as a depth of experience type potential. And again, when all the companies are getting beat up over the probabilities of insurance payments being made and that type of stuff, these guys have weathered those type of storms before. Here's a look at the last 10 years or so. It is in the extended coverage for value line. And basically what you're looking at here is the book value on that red dotted line. Very straight, growing at about 11% per year. The green bars are the price, and you can see that on the right-hand side, the price has cycled to multi-year lows. They're trading down just under $30 a share now. The situation in 2020 and 21, we're going through a moment. we're going through an outlier. We're going through a chasm. So again, it's kind of that distressed merchandise, damaged good type thinking, where you look at a company like this and you have to say, I think they're going to come out the other side. Their balance sheets are strong. They've got things in place to mitigate a lot of the stuff that's going on. They've managed to retain all of their employees are still employed, trying to pursue and execute business. So you've got a company growing at about 10% after 100 years, pulling in a return on equity somewhere in the low teens, very respectable trend and characteristic there, at a PE ratio that's typical of these type of specialty insurance companies and property and casualty, somewhere in that 8 to 10 or 12 range. So I used 10% for growth, got a little bit frisky with the return on equity at 14 and a PE ratio of 10. Under those conditions, again with an eye on not what's going to happen in, well, the next time they report earnings, it'll be the end of July, and it'll be ugly. I'm not thinking July 2020. I'm thinking July 2025 or July 2030. When we make these types of studies of companies, under those conditions, we are looking at a potential return in the low 20s. And they do pay a fairly decent dividend of 1.5% to 2%. But if you believe this too shall pass, this is a company that has done it before, and I suspect they'll have a high probability of doing it again. So we'll add EIG to the tracking portfolio. All right, Ken, if you're still awake out there.
And here's our poll, folks. We'd now like you to decide which one of these you think the audience should add to our portfolio. You have the 4 choices made by the 4 knights, and you can also choose to vote for none of the above. It just takes a little bit of effort. If you have a touch screen, you can touch what you want. If you have a mouse, you can mouse to your choice. We're up to 2/3 of you voting. We'll give you another 10 seconds or so to make your choice. Well, let's try to push it up to 3/4 if we could, folks. We're up to 71%.
I've been known to send out gift baskets.
Doesn't cost anything to vote. All right.
Apparently the
Okay.
fix is in. I see a few people saying they can't vote.
Oh, man.
Well, no, I haven't closed anything, so they should be able to vote.
Must be a Georgia thing.
Illinois, I heard.
Wow, we've got a boatload of them.
Well, no,
Yeah,
in
there's
Illinois, you get to vote multiple times.
Yeah, the questions box is getting overwhelmed with I can't vote.
Huh. That's a first.
Well,
It is.
I don't know what to tell you, folks, except that we're getting a lot of votes in. So I am going to close the voting down. And I know there's going to be an outcry this time because my stock was the one that.
Oh, please. Please.
Oh, I'm having a network interruption.
Are we offline? I can still hear you.
Yeah, I don't know.
I can still hear you.
Oh, wow.
Yeah, you're not showing this month's results.
There we go. There we go. Okay. And this does represent 78% of the vote. So we'll add an extra hexel. I need to keep that shared while I'm talking there. Add an extra hexel to the portfolio. And folks, I will be with log me in tomorrow to find out what would have caused us to have voting problems. That's never in the 10 years that we've been doing this. We've never had a problem with voting before. So I will try to find out the reason.
Shall I have my election attorneys call you, Ken? Or
I was
have
going
your
to say,
attorneys call it.
as the second finishing candidate, I protest this election.
Si, you can come up and count the hanging Chad, Si. Okay. All right.
he knows about those two.
Okay.
He's right next door. All right.
So I'm going to put us back to the. There we go, Mark. Okay.
All right. Well,
Mark, you wanna tease the second one a little bit?
let's tease a bit. Well, we're gonna get together in about a week or so and talk about the market on May 6th. But we do want to tease this one a little bit. We've dubbed it the COVID Cancellation Conference, and what we're going to do is put together an online event. It's going to last a period of 3 days or so, and it'll start on Thursday night with a panel discussion, and then we will have independent, freestanding webcasts. We've invited a number of people, including everybody that's here tonight, to consider presenting a theme or a topic of great interest. You guys know the drill. Let us know what you'd like to hear about or see. But basically what this comes down to is I'm tired of getting canceled, and I'm tired of canceling out on people. And we've missed appearances in St. Louis and Dallas and Philadelphia. Where else, Ken, haven't we been?
Indianapolis, Columbia, South Carolina. We've just missed all kinds of things that we normally do around the country. We miss talking to you face to face, and we know that a webinar doesn't come close to recreating the face to face experience. But we've invited the Knights, along with a couple of our favorite presenters, to do a Let's Talk Stock, just a good old-fashioned Let's Talk Stock as the opening to the COVID cancellation conference. And then we'll try to run 3 or 4 opportunities for you in the next couple of days. You can come to one or none or all of them if you wish. And Natalie will be sending out reminders to our mailing list. We're reminding about 1,400 people now, so we're really pleased with that. We're going to also make it clear that you can share that reminder with anybody else that might be interested. The link is not specific to who it's mailed to, so you can forward that note to as many folks as you want, and the links will work for you and they'll work for the people that you forwarded it to. So we hope we'll get as many people as we had in the last couple of roundtables. We've had real nice audiences, and if you have something you really, really would like to have one of us talk about, drop Mark an email quickly, because we're in the planning stages of finalizing what these group webinars are going to be like. So drop the idea to Mark as soon as you can.
Yeah, and I think
Mark at manifestinvesting.com. Again, just plain old Mark at manifestinvesting.com. Go on, Mark.
Yeah, and Mark R works probably better. Mark R at manifestinvesting.com. And I will share that there's no way we're not going to do this without talking about small company discovery as one of the sessions. Ken's told me I can't tell you the other topics, but they're a work in progress. But that's an example of a topic, because it is just there's just this wonderful field of opportunity right now in small and medium-sized companies, and we really need to dig in and basically capitalize on our experience over the last 10 years with the small company stuff that we do every Halloween, and that's just an example.
All kidding aside, there's a lot of Hexels out there right now, and Hexel is nowhere near the size company of VMware or United Airlines, or so there's a lot of really good small mediums and just plain old smalls out there for us to take a look at. We'd love to share some of our thoughts and maybe do a little bit of screening and maybe give you a couple of good ideas on top of it.
Yeah, we always like to share our favorite screens and the results and share some ideas for you to study. So that's obviously part of it. And we actually have 8 or 9 favorites. We're going to have trouble boiling it down to a group of 4 or 5 webcasts, but we'll do our best. I'm tempted here at Manifest to put together maybe Zoom as part of, a Zoom session for a little bit of face-to-face as part of this also. Completely experimental, but I think it's something that we could try. I know many of the people in the audience. My wife is a Zoom goddess upstairs here for Fiat Chrysler, and it can be a very effective way to stay in touch. And we might experiment with a little bit of that, either as part of it or adjacent to this COVID cancellation conference. And we're going to be
Mark,
Go ahead.
We do have quite a few questions, so if you want to close this down, folks, 2 or 3 of you have asked if this will be on YouTube, and the answer, as always, is yes, it will be. It might take a day or 2 to get it up there, but it'll be on YouTube. You can look at Manifest Roundtable, Mid-Michigan Roundtable. Those are all different names of the channel, and it'll get you to the right channel. Roundtable will even get you there. And once you find the channel, if you actually sign up for it, then you'll get emails about every time it's updated. Plus, you'll have a link to take you right back to where you want to be without a lot of searching. And this one, just like all the others, will be up there just as soon as we can get them ready to go.
Okay, well, this is running a little bit long for the recording, so I'm just going to go ahead and say thanks to all the attendees, and we will stay on the line for a little bit of extended Q&A for those that want to stick around. But thanks to the attendees, and thanks to all of you for your contributions to this program over the many years. And it's been an excellent experience, and just want to say thanks to everybody. And with that, I will say good night, and we will be in an extended session. Thank you.